Okay, and starter 3. So we have Jack, who has business providing football coaching. So Jack buys a car for business use and pays by bank transfer. So our 4 things. Okay, source document. Since he's buying it for cash, he's paying upfront in cash. It's not going to be invoice because that's due for credit. So there's 2 you could say for a source document. The best one should be some kind of it should be some kind of cash receipt. Yeah, because if you buy something, you should get a cash receipt for it if you use cash. Or since it's bank transfer, you could say bank statement, but the better one would be the cash receipt. Book a private entry. Well, it's to do with cash, so it goes in the cash book. Now this one, I can imagine a few people will be tricked and put general journal because you read car. However, general journal is only for non-current asset on credit. Since it's paid on cash, it will go in the cash book. Debit and credit, well, one would be the vehicles account, and the other one is going to be the bank account. Well, the bank is losing money, there's money going out of the bank, so that's the credit, and we're gaining an asset, so that's a debit. So vehicles. Okay. Next one. So the cost of the car is £14,000, and he depreciates the vehicle by 15% per annum using the straight line method. So remember the straight line methods where where it's the same amount each year. So to find the yearly depreciation, we do 15% of 14,000, which should give us 2,100. He has this for 4 years, so 4 times that is 8,400. So the net book value after 4 years is 14,000. Take away the total depreciation. So this is my provision for depreciation, which is 5,600. So that's how much the vehicle's worth. He sells it for £4,000. That's definitely a loss. And it's 5,600. Take away 4,000, so it's a loss of £1,600. So yes, that would be an expense on our income statement, or on Jack's income statement. Third one, Jack's accounting year ends 31st of May 2020. So that means it began June 2019. He's got 1,500 for car insurance and income statement. However, included in this, it's his annual renewal of £900, which ends October 2020. So annual, so that means it must have began November 2019. And he's paid it, so that means the prepayment. So November to May should be included. So it's June to October, that's a prepayment. So count how many months. So June, July, August, September, October, so that's 5 months. So to get the cost of 1 month, we do 900 divided by 12, which is £75, times it by 5, which is 375. Now that shouldn't have been paid this year. Yeah, well, it could have been paid, but it shouldn't be included in this year's income statement because of the accrual concept. We only put on the income statement the expenses for this year, so we need to take away that and get £1,125 on the income statement. And that prepayment is an asset, so it's going to be other receivables, 375 on the soft under the current asset section. These other 7 months, November to June, I'm not going to bother working it out because that's already included in that 1,500. So I don't need to work that out. yeah, what you should find is you work out one number and you use that number twice. So if it's a prepayment, you take it away, and it depends if it's an expense or income, and if it's an accrual, you add it on because it shouldn't have been paid. Okay, Jack's transferred £500 from his own bank account to the business bank account, but forgot to record this in his accounts. So if he's forgot to record it straight away, it's an error of omission. I think it's 1N. Yeah, error of omission. And so let's think about how it looks. So transferred £500 from his own bank account to the business bank account. So for the business bank account, I'm just going to call bank. His own bank account, we don't call it Jack's bank account. If he's inserting money himself, then that's capital. So at the minute, he hasn't put anything in those accounts from this transaction, but it should have been money into the business bank account. That's increased the debit, and capital is a credit, so 500 on that side. So the general journal should look like the debit was the bank, and the credit was the capital. Well done if you spotted that. And the last one, explain the difference between doubtful debts and irrecoverable debts. So doubtful debts and irrecoverable. Okay, irrecoverable debts are debts that are very, very unlikely to be recovered. So that could be because the customers went bankrupt. It could be that you haven't got the details for the customer, so you write them off because it's very, very unlikely you're going to get that money back. Whereas on the other hand, doubtful debts is we have a provision for customers who might not pay. Yeah, so at this stage, we're not saying they're never going to pay. We're saying we're anticipating that some won't pay, so we're kind of putting some money aside as an expense, thinking that they might not pay. Now, when it turns into they're not paying, that's when they'll become down here as an irrecoverable debt.